Hello guys, this is chapter 11. In this chapter, we're going to discuss about the basic of capital budgeting, mainly what are the different decision rules that the firms use in order to determine if they would like to invest in a project or not. So what you'll notice is that for the last two chapters, which is chapter 11 and 12, we're going to talk a lot about capital budgeting. In chapter 11, we talked about the decision rule. In chapter 12, we talk about how to estimate the cash flow. First, let's go over what is capital budgeting. So, what is capital budgeting? Capital budgeting is the process of planning and evaluating expenditure on assets whose cash flow are expected to extend beyond a year. So, if you're looking to take on a project that will be a long-term project, let's say, for example, building a plant, and a plant is a long-term asset, so your decision to build a plant will be a capital budgeting decision. And in this chapter, we're going to see how you can actually use time value of money to determine the value of the different projects and to choose between projects. Why is capital budgeting essential? Capital budgeting is essential because it allows you to analyze the potential additions to fixed assets. So for example, if you're building a plant, what will be the impact of the new plant on your profit, on your net income? It allows you also to make a long-term decision which involve large expenditures. So most of the time, the project that you will evaluate using capital budgeting will be project that will involve large expenditure or large cost or large expenses. And also it's very important for the firm future because it allows you to determine how the project in which you invest will affect your firm's future. So what are the steps to capital budgeting? First, you estimate the cash flow. You estimate the cash flows, you estimate what will be your cost, you estimate what will be your profit every year, you estimate what will be your outflow and inflows of cash flow. Then you assess the riskiness of the cash flow. The riskiness of the cash flow is the probability that you're actually going to receive this cash flow. Based on this riskiness, you determine what's the appropriate cost of capital. The cost of capital is the minimum required return that you need to receive from this investment in order to be able to compensate your shareholders. So you need to determine what is this cost or this return that I can get on the project that will be enough to compensate my shareholders. Then when you have the cash flow and you have the cost of capital, you're going to determine what is your net present value. The net present value in this case will be the difference between all the positive cash flow that you're going to get and the cost that you're going to pay at year zero, which is a little bit different to the way that we've been using NPV so far, in the sense that so far we were assuming that your cash flow in year zero will be zero, but in the case of capital budgeting, your cash flow in year zero will actually be the cost that you pay in year zero. Then we're going to go over IRR. And IRR is the internal rate of return. So IRR is actually what's the return for which you're going to have a zero NPV, so for which you're not able to get any profit from your project. So once you find the NPV and the IRR, you're going to determine if you want to accept the project or not. And to determine that, you'll need to look at these rules. Mainly, you're going to accept if NPV is higher than zero, or if your required rate of return is higher than the cost of capital. If NPV is higher than zero, that means that this project allows you to make a profit, which is good for your firm. And if IRR is higher than the cost of capital, that means that you're able to get a return that's higher than the minimum return to compensate your shareholders. So then your shareholder will be happy with you taking that project. But first, let's discuss about the different type of project that you may have. You actually may have two types of projects. You may have independent projects. So what's an independent project? Independent projects are projects whose cash flow are not affected by the acceptance of the other projects. So that means that if you have two projects, let's say that for example, you're trying to buy new computers for your company, and at the same time you're going to build a new plant. If these two projects do not affect each other, then we're going to say that the independent project. Buying the new computer doesn't affect the building of the new plant, then there will be independent project. So in this case, you can decide to invest in both, or you can decide to invest in one of them. There's no issue with that. The second type of project are the mutually exclusive projects, which are projects whose cash flow can adversely impact the acceptance of other project. So let's go back to the same example that we had. So let's say that you need to buy a new computer, and at the same time you need to build new plants. However, you only have the same amount of money for these two projects. So that means that you can only invest in one of them. So maybe you can invest in the computers, then you don't have any money to invest in the new plant, or maybe you invest in the new plant and you don't have any money to invest in the computers. So this will be an example of mutually exclusive project. When you have mutually exclusive project, you cannot invest in both of them because you won't have enough cash to invest in both of them. You will not be able to invest in both of them. So what you're going to do, you'll need to choose. So why is it important to know the difference between independent project and mutually exclusive project? Because when you look at your rules, when you look at your NPV and IRR, if NPV and IRR give you a decision to accept for both projects, if they're independent project, you can accept both. But if they're mutually exclusive, then you only accept one, and you're going to go with the one with the highest NPV and with the highest IRR. So this is the example that we're going to use today. That's the example for project L and S. So let's say that you're in firm and the firm has to invest in two projects. Project L, which will give you a cost of -100 in year 0. Then in year 1, you're going to make a profit of 10. In year 2, you're going to make a profit of 60. And in year 3, you're going to make a profit of 80. Then we have project S, which will give you also a cost of -100 in year 0. It's going to make a profit of 70 in year 1, then a profit of 50 in year 2, then a profit of 20 in year 3. You see next to the two cash flow, we actually have the difference in cash flow. Right now we're not going to focus on that. We're not even going to talk about that. We're going to come back to it later because it will allow you to determine a very important element that we need to look at when we're going to choose between these two projects. So the first decision rule that we're going to look at is NPV. So mainly what's NPV? I know that if you went over the chapter on time value of money, if you went over the chapter on stock valuation, you must have an idea now of what NPV is. NPV is the sum of all the cash flows that you can receive. In the sense of a project or for capital budgeting, NPV will be the sum of all the cash inflow and outflow. So that means it will be the sum of all the positive cash flow that you get every year, plus or minus, because it's a cost, the cash flow that you get in year 0, which is the cost that you have to pay in year 0. And that cost will always be negative because it's an outflow. So if you want to use a formula, this is the formula. So what you're going to do, for each cash flow, you're going to determine what's the present value, and then you're going to have the sum of the present value of each cash flow, and that will give you NPV. Or you can use your financial calculator and you're going to use the CF and NPV keys. So just for you to remember where you can find the CF and NPV keys, let's go back to the calculator. So this will be the CF key and this would be the NPV keys. So one thing that you have to remember when you input the values is that your cash flow 0 is a negative cash flow. So that means that if you're using your calculator and you have a cash flow 0 or you have a cost in year 0, you're going to enter CF0 equal minus the value of the cost in year 0. And it will be equal to your initial investment or initial investment cost. If you're using Excel, what you're going to use is the same formula that you've been using for NPV. You're going to include your rate. However, your cash flow, you're going to go from cash flow 1, which is the cash flow for the first year, to the last year, and then you're going to add cash flow 0. And remember, we assume that cash flow 0 is negative, so you're going to add the negative value of your cash flow 0. So this is what you're going to do if you're going to use Excel. And we're going to see an example in Excel using Project L and Project S. So now we're going to go with the first example, which is with Project L. So there's two ways that you can compute, or three ways, sorry, not 2 ways, but 3 ways. First, you can use the formula. Second, you can use your calculator. Third, you can use Excel. So if you use your formula, that means that for each year, you're going to compute what is the present value. So in year 0, you're going to have a cost of minus 100. This minus 100 will have a present value of minus 100 because you're already at year 0. Then in year 1, you're going to get a cash flow of 10. So you're going to determine what's the present value of the $10 that you get in year 1 at year 0, and that will give you 9.09. Then you do the same for year 2. You determine what's the present value of the $60 at year 0. And then you do that for year 3, present value of the $80 at year 0. And then based on what you find, you're going to do the sum. So look in the sum, you include your cost, then you include the present value of all the cash flows. And if you compute, that will give you 18.79%, $18.79, sorry. If you're using your calculator, that will be a little bit faster because instead of having to compute what's the present value of each and then do the sum, the calculator will do that for you. So let's see how you're going to do using your calculator. So using your calculator, you're going to enter all the cash flows into your cash flow register. So then let's go here. In my calculator, the cash flow register is CF, and if you're using other calculator, it can be CAFLO, but it's CF on the BA Plus, which is the calculator that you're supposed to use. So then you're going to press on CF. So the first thing it's going to ask you is for CF0. Here CF0 is the cost that you pay at time 0. So here the cost will be minus 100. So minus 100, and you press enter. So make sure that you put the right sign for your CF0, or what the calculator will do, it will just add the cost instead of removing the cost. So when you enter in the calculator, make sure that CF0 has a negative sign. So then you go to the first year, going to ask what's your cash flow for the first year. So you're going to select here 10. And then you go enter, done error. Was going to ask you how many times you have 10. Here we only have it once, so you're going to put 1. Then you're going to ask for the cash flow in year 2. The cash flow in year 2 is 60 here. So you're going to put 60, enter, done error. How many times you have 60? Once, so you're not going to change it. So finally it asks you for cash flow in year 3. That will be 80. So you enter, done error. That will give you the factor for your 80, which is 1 here. You don't have more than 180 in your cash flow. So then after you put all the information for the cash flows, we're going to go ahead and put the information for the interest. In this example, we assume that the interest is 10%. So based on the previous slide that you saw, the cost of capital was 10%. So this is what we're going to use for the interest. So the interest will be 10%. The calculator, you put it as a whole number, so you put 10. In Excel, make sure to put it as a decimal. So you press enter, done error. It's going to ask you for NPV. You press compute NPV, and it will give you what's the NPV for this project. So if you're looking at investing in Project L, you're going to have NPV of 18.78, which is the same value that we have on the PowerPoint. and this is higher than 0, so that means that you can actually invest in project S, because it's a project that gives you a positive NPV, a NPV higher than 0, meaning that you're actually making a profit of $18.78 for this project. So then if you're using Excel, what are you going to do? Let me show you that. So if you're using Excel, and let me move it a little bit here, you have to enter the cash flow for each year. So I will advise you to do it this way, so that you can actually be able to see if you actually put the right sign for the cash flow. You can directly go to the NPV formula and do it the same way that we've been doing for the previous cases. However, for the capital budgeting example, I would prefer that you actually state your cash flow, so that you can check if you actually put the negative sign for your cash flow 0 or not, because that will affect the value that you find for your NPV. So here, project L, the cash flow in year 0 was 100. You pay 100 for the project, so it would be minus 100. And let's make it big a little bit so that you can see where I'm actually putting that information. Okay. So then in year 1, you're going to have a cash flow 10. In year 2, you have a cash flow 60. In year 3, you have a cash flow 80. Contrary to the calculator, here you do not have to put the factors. You just have to put the values in, that's it. You do not have to put the factors. So now to compute NPV, what do? I'm going to go equal NPV, open the parentheses. It's going to ask you for the rate. And let's back up a little bit. Here the rate is 10%. So we're going to put 10% at our cost of capital. So then you go to your NPV, equal NPV. You open the parentheses. The first thing it will ask you is for the rate. The rate is 10%. Then it's going to ask you for value 1, 2, 3. So here you do not enter the cash flow in year 0. You only enter the cash flow starting in year 1. So then you're going to select cash flow 1 to cash flow 3. Or if you want to do it manually, you can just select cash flow 1, then comma, cash flow 2, then a comma, cash flow 3. Then you close the parentheses, and then you add your cash flow 0 at the end. So contrary to the NPV that you've been using so far, when you're looking at the capital budgeting, or when you're looking at investing in project, you're going to have a cost that you have to pay to invest in this project. So what you're going to do, you're going to find first the present value of all your cash flows when you look at when you're using Excel. Then to this present value, you're going to add the negative value of your cash flow 0, which is the cost that you pay in cash flow 0. So then you press enter, and that will give you the value for NPV. Here I think the Excel sheet was set up in percentage, and that's my fault, and I'm very sorry about that. So I'm changing that in dollar. So then we're going to find the same answer, which is $18.78. So remember, NPV is in dollar. It has to be higher than 0 for you to accept. I will be in percentage because it's a percentage, is the return, and it has to be higher than the cost of capital. So in this case, your project is 18.78. Is it higher than 0? Yes. Are you going to invest? Yes. So then this is how you can actually compute the NPV for a project using Excel. So in order to make sure that you actually know how to do it, we're going to do the same for project S also. We're going to compute the NPV for project S. So what is the NPV for project S? Like for project L, you can use the formula. Using the formula, which means compute the present value for each of the cash flow and then add them together. Or you can use your calculator, or you can use your Excel sheet. So using the calculator, make sure that after each computation of NPV, you clear your cash flow line, because if you don't, that will affect your calculation. So here I clear my cash flow line, and I'm going to enter the new cash flows now. So times 0, we're going to pay a cost of 100. So our cash flow is minus 100. Enter, done error. First year, you get a profit of 70. So enter, down arrow. How many times you get that? Once, so you do not change your factor. Year 2, you get a profit of 50, enter down arrow. How many times you get that? Once, so you're not going to change it. Then year 3, you have a profit of 20 that you enter. How many times you have that? Once, you're not going to change it. Then you're going to go to NPV. In this case, the cost of capital is 10%, so you're going to put 10 as your interest, enter. Then you're going to go down arrow and compute NPV. So if you look at projects S, the NPV for project S is 19.98. Is it higher than 0? Yes. Are you going to invest in project S? Yes. So let's say that you're trying to use Excel then. If you're using Excel, let me clear the value that we have here. So for project S, you're going to have a cost of minus 100 in year 0. In year 1, you get 70. In year 2, you get 50. In year 3, you get 20. Your cost of capital is still 10% for both projects. So then you're going to go to NPV equal NPV. You open the parentheses. You're going to include the rate. Then you're going to include your cash flow starting at cash flow 1. So cash flow 1, then cash flow 2, then cash flow 3, and you close the parentheses, and then you're going to add your cash flow 0 as a minus value, remember. And then you press enter, it will give you the same answer, 19.98. So looking at the NPV, you're going to accept project S also. However, there's an element that will affect your decision to invest in project S or in project L. It's whether these projects are independent or not. But before that, let's go over what's the main rationale behind NPV method. So you saw me using Excel and the calculator, compute NPV, and compute the present value of the inflows and add the minus the outflow or the minus cost from year 0. So why did I do that? The main assumption is that NPV allows you to determine what's your net gain in wealth or what's the net profit that the firm is going to have with this project. So what you actually do with NPV is actually computing what's the present value of all the cash inflow that you have in the future, and then you remove from that the cost that you actually pay today. This gives you how much on average you're supposed to receive from that project, or what's the value of the project today. So the question will be, when are you going to accept, or are you going to accept both projects or not? That depends on if the projects are independent or mutually exclusive. So let's say that you still have a project L and S, and to remind you, I will give you the value for the NPV. So L, S. So L was 18.78. S was 19.98. So first, let's assume that project L and S are independent, meaning that project L and S will not affect each other. If they don't affect each other, if you find that NPV is higher than 0, you're going to accept both. So here, project L, NPV is higher than 0. Yes, it's 18.78. Yes, you accept. Project S, NPV is higher than 0. Yes, it's 19.98. Yes, you accept. Another element is that, what if the projects are actually mutually exclusive? So that means that if you accept project L, it's more likely to affect project S. Or if you accept project S, it's more likely to affect project L. In this case, you're going to accept the project with the highest NPV. So you're going to go with the one that adds the most value or has the highest net gain in wealth. So let's compare project L and S under the assumption that they're mutually exclusive. We see that actually the NPV for project S is higher than the NPV for project L. So if they're mutually exclusive, you're going to accept S. Why? Because NPV is higher, the NPV of S is higher than NPV of L. If they're independent, then you accept both. Why? Because NPV is higher than 0 for both. So now that we know about NPV, how to compute NPV, and how to choose a project based on NPV, we can discuss about the internal rate of return. So what is the internal rate of return? The internal rate of return is the discount rate that forces the present value of all your cash flow to be equal to 0, or the NPV to be equal to 0. So what do you mean is that if you take the present value of both your cash inflow and your cash outflow, you're going to have a value of 0, and if this value is equal to 0, that means that the present value of your inflow will be equal to the present value of your outflow. So your assumption is that with IRR, you find the cost for which the present value of your inflow is equal to your cost or your outflow that you have to pay for the project. So this is the formula that you use in order to compute IRR. So what you do, you set up the NPV equal to 0, and you compute the sum of the present value of all the cash flow, assuming the value of IRR. If you're trying to use the formula, it will be a little bit difficult, and I'll tell you why, because you're going to have to do a trial and error. What does it mean to do a trial and error? That means that you're going to use different percentages, include the percentages until you get a NPV equal to 0. So as you might know, it will take a little bit of time for you to be able to do that. So another way that you can actually compute your IRR is actually by using your calculator. So in your calculator, you're going to enter your cash flows in your cash flow register, or in the CF, you're going to press the CF key and put the cash flows inside it. And then you're going to press IRR. So let me show you on the calculator here. So first, what you're going to do is, first you're going to press on CF, enter the cash flows. Then after you enter all the cash flows, you're going to press IRR, and then you press compute, and it's going to give you the IRR. Here it's saying error 5 because I did not have any cash flow inside anyway, so that's why it's saying error 5. And when I will go over the example for project L and S, we're going to be able to do the calculation because we actually have cash flow inside the calculator. What if you're actually using Excel? So if you're using Excel, this is the formula that you're going to use. You're going to use equal IRR, select all your cash flow, including your cash flow in year 0, and then you can guess for a rate. So you can put maybe 10% and have the calculator after the Excel compute IRR, but this is completely optional. With IRR in the Excel, you just have to make sure that you have the cash flow in. You do not necessarily need to have a guess rate. That's completely optional. So what you're going to do, you're going to type CF in Excel, type your cash flows in Excel, then select all the cell of the cash flows. So contrary to NPV, where you can actually enter each value separately, for IRR, what you need to do is to actually select all the cash flows, or select the cells for your cash flow. So you're going to have your values. So what you do, you select all the cells this way, and then close the parentheses. You cannot go ahead and put, for example, let's say you're putting for each cash flow, so B3, then B4, then B5, then B2, and close. You will not be able to compute IRR. It will ask you that you have too many arguments for this function, because the function is only supposed to have your array of cells and your rate and your guess rate, which is completely optional. So in this case, you cannot go like the NPV and select each. You just have to select the whole array and put it inside your IRR formula. So let's apply what we just learned on project S and project L. So we're trying to compute the IRR for project L, and here I'm not going to try the formula because that will take us more than 1 hour in the presentation, and I'm sure that you do not have time to watch a video of 3 hours or 5 hours or a whole day. So what we're going to do, we're going to go straight to the financial calculator and the Excel solution. So what are you going to do for your financial calculator? So for your financial calculator, you're actually going to go to your financial calculator, go to your cash flow register. Always make sure that your cash flow register is empty, and to empty that, you just go second function clear work. So then you're going to have 100 or minus 100 for your cash flow 0, because project L, the cost in year 0 was 100, so minus 100 cash flow 0, enter. Then error is going to ask you for the cash flow for year 1, so that will be 10, enter. Then error, how many times you have that? Once, so you do not change the factor. Then they're going to ask you the cash flow for year 2. Here it's 60, so you go to 60, enter, down arrow. How many times you have that? Once, so you're not going to change the factor. And then finally, year 3, you have 80. You press 80, enter, down arrow. How many times you have that? Once, you're not going to change the cash flow. Then, when you have all these cash flows, what you do, you go directly to IRR. You do not need to go to NPV anymore. You do not need to enter the interest anymore. You just go to IRR and you press compute. So if you go to IRR and you press compute for project N, you're going to see that the project will have a IRR of 18.13% roughly. So if we apply the decision rule here, you're going to see that this is actually higher than the cost of capital, which is 10%, and then you're going to want to invest in project L. So the question would be, what if I'm not using the calculator and I'm using Excel? Can you show me how to compute? Yes, I can. So this is what we're going to do. First, you're going to enter your cash flows, because you need these cash flows in order to do your computation. And let me clear that and enter the cash flow. So your cash flow in year 0 is minus 100. Cash flow in year 1 is 10. Cash flow in year 2 is 60. Cash flow in year 3 is 80. So we go back to the same NPV because I didn't clear the formula anyway. So then you go to equal ARR, and then you open the parentheses. It's going to ask you for the values. Remember, you have to select the array of cells. You have to select all the cells. You cannot go ahead and put each number. You have to select all the cells. So then they will ask you for a guess rate. It's optional. You do not have to enter a guess rate. You can just close the parentheses and it's going to make the calculation, which I'm going to do here. So then enter is giving you the percentage, and let me make sure that we have a little bit of decimal, so that will give you 18.13%. which is the same thing that we found on the PowerPoint. So if you're using your calculator, make sure that you put the cash flow and then you press IRR. If you're using Excel, you put the cash flow, then you put equal IRR, and you select the array of cells in order to include that into your formula. So let's apply that to the second project that we have, which is project S. So we have the cash flow for project S here. We have the cash flow for year 0, year 1, year 2, year 3. So we go back to the cash flow register, make sure it's empty. So second, clear work. So first we put the cash flow for year 0, which is minus 100, enter, down arrow. Then we put the cash flow for year 1, which is 70, enter, down arrow. How many times you have 71, so you do not change the factor. Then we put the cash flow for year 2, which is 50, enter, down arrow. How many times you have 50? Once, so you're not going to change the factor. Then we're going to put the cash flow for year 3, which is 20, enter, down arrow. How many times you have that? Once, so you're not going to change the factor. So now you have our cash flow inside. You just go back to IRR and you press compute. So if you use your calculator, you find that your IRR is equal to 23.56%. And remember, the steps are easy. Just enter the cash flow, just press IRR, and just press compute. Let's say that you're using Excel. The question would be, how do I compute with Excel? That's what we're going to do now. So if you're using Excel, first thing, put your cash flows. Cash flow in year 0 minus 100. Then cash flow in year 1, 70. Cash flow in year 2, 50. Cash flow in year 3, 20. Then you go to your IRR, press equal, IRR, open the parentheses. Always remember, you select the array of cells. You do not actually enter each cells. So then you close the parentheses and you press enter. And then you find the same answer. IRR equal to 23.56%. So the question will be, will you invest in project S? Yes, it's higher than the cost of capital, which is here 10%. So cost of capital is 10%, the minimum return that you want to give your investor is 10%. Your IRR is 23%. Your investors are actually getting 13% more. For sure, you're going to invest in project S. However, the decision to invest in project L or S is still affected by whether the projects are independent or mutually exclusive. So let's go over the rationale for IRR method. So the rationale for the IRR method is that IRR is higher than the cost of capital, so the project return exceeds its cost and there is some return left over to boost stockholder return. So that means that if your IRR is higher than the cost of capital, you have enough return for your stockholders to be satisfied, and you even have excess return that you can actually give to your stockholder. So what will happen if IRR is higher than cost of capital? You're always going to accept the project. If IRR is less than the cost of capital, you're going to reject the project. However, the distinction would be if you have independent projects or if you have mutually exclusive projects. So just as a reminder, project L had the IRR of 18.30%. Project S had the IRR of 23.56%. So now we're going to see if we're going to accept the projects when they're independent or when they're mutually exclusive. So if the projects are independent, meaning that project L and S do not affect each other, then you're going to go with the basic rule of IRR, which is IRR higher than cost of capital, you accept. In this case, the cost of capital is 10. Looking at project L, we have a IRR of 18, which is higher than 10%, you're going to invest. Looking at project S, you have a IRR on 23.56, which is higher than 10%, you're going to invest. And they're not going to affect each other, so you're going to invest in both. What if these projects are actually mutually exclusive? That means that you can only invest in either project S or project L. So then you're going to take the one that has the highest IRR. Not only the one that has the highest than the cost of capital, but the one that has the IRR highest than all of the other projects. So here, if we look at the IRR, project S actually has the highest IRR. So if you have mutually exclusive project, you're going to accept project S and not project L, because the IRR of project S is higher than the IRR for project L. Okay, so now we're going to go over what we call an NPV profile. Why is an NPV profile good? An NPV profile allows you to determine what is the different NPV at various cost of capital. So if your cost of capital is 0, if your cost of capital is 5%, if your cost of capital is 10%, 20%, or 15%, what will be your NPV? And as a reminder, the cost of capital is the minimum return that the investors would like or your shareholder would like to receive. So what you do for each of the projects or for each of the cost of capital, you're going to compute what's the value of each of the projects. So let's say, for example, that the cost of capital is 0, then project L will have an NPV of 50. Let's say that we look at project S, the NPV will be 40. If the cost of capital is 5, NPV is 33, NPV is 29. If the cost of capital is 10, NPV is 19, NPV is 20. If the cost of capital is 7, NPV is 15, NPV is 7, NPV is 12. The cost of capital is 20, NPV for project L is -4, NPV for project S is 5. So why is it good to have your NPV profile? It actually allows you to make a better decision when you actually have a mutually exclusive project, because you're able to see at different cost of capital what will be the profit that you're supposed to receive for each project, and it will allow you to know at which period of which level of cost of capital when one project will be best than the other, and at which level of capital one project will be worse than the other. So this is actually a graphical representation of the NPV profile. So you calculated all the NPVs, then you plot it actually on the graph, and your graph will have as a y-axis NPV, and as a x-axis it will be the cost of capital or the minimum required return for your investors. If you have a dependent project, what you'll see is that the NPV profile of each of the projects will actually be parallel. So that means that you're going, for example, to have project S, and then you're going to have project L, and then you're going to have project W. Any project that you have, they will never cross each other, and they will be parallel, so they will not even affect each other. So in this case, you're going to go with the general assumption. So if NPV is higher than the cost of capital, you accept. If IRR is higher than the cost of capital, you accept. If NPV is higher than 0, you accept. So let's look at this profile. And when you look at this profile, until you get to 18.1%, which is your actual IRR, you're always going to accept the project. Why? Because your IRR is higher than the cost of capital and NPV is higher than 0. So if your cost of capital is between 0 and 18%, you're going to accept. But look at what happens as your cost of capital becomes higher. If your cost of capital is higher than the 18.1%, what happened? You're going to reject the project, because the project that you're investing in does not give you enough return to compensate for your cost of capital. So let's go over when you have mutually exclusive projects, what do you do? So this is the NPV profile for two mutually exclusive projects, and here S and L are actually mutually exclusive projects. And you can actually see if your projects are mutually exclusive by actually looking at the NPV profile, because if they're mutually exclusive project, at one point these two NPV profile will actually cross each other, or there will be a moment where the NPV of one project will be equal to the NPV of the other project. So this is what we have here. So here we have the NPV profile for mutually exclusive projects. So what do you see? When the return is equal to 8.7%, the NPV of L is actually equal to the NPV of S. So if you have a project and the cost of capital is 8.7, then you'll be indifferent between using project L or S, because they both have the same cost of capital. So what happened, for example, if your cost of capital is lower than 8.7? If your cost of capital is lower than 8.7, then the NPV of L will be higher than the NPV of S. And you can look here, looking at the NPV profile, you see that the NPV of L is always higher than the NPV of S when you look at the cost that's less than 8.7%. However, what happened for the IRR? There is no change. The IRR will still be the same value. The IRR will not change based on which cost of capital you're using. So then, looking at the IRR, you might not have the same answer. And for cost of capital less than 8.7, we see actually a conflict. We see that NPV NPV of L is higher than NPV of S, so it's telling you to invest in L, but IRR is telling you an opposite story, that you need to invest in S. Whenever there's a conflict, you go with the NPV. And in a couple of slides, we are going to go over why NPV is the best method for you whenever there's a conflict. So let's look at the second part. Let's say that your return is actually higher than 8.7%. So if your return is higher than the point at which NPV of L is equal to NPV of S, you see that there's no conflict. What happened? NPV of S is higher than NPV of L, and IRR of S is higher than IRR of L. So you do not have any issue. Both are telling you the same thing, that you have to invest in project S. But how do you determine this point, this crucial point where the NPV of two projects are actually equal? For that, you're going to determine what we call the crossover rate. So what is the crossover rate? The crossover rate is the rate at which the NPV of two projects or multiple projects will be the same. So how do you determine the crossover? First, you need to determine the difference between the cash flows. So here you have the cash flow for project L and S, and you do the difference for all of the cash flow. So in year 0, you're paying minus 100 for project L and project S, so the difference will be 0. In year 1, you're getting 10 for project L and 70 for project S, so the difference will be 10 minus 70, that will be minus 60. Then for project L in year 2, you have 60, project S you have 50, so you're going to do 60 minus 50 is going to give you 10. So finally, you're going to do 80 minus 20, and it's going to give you 60. So then what do? Instead of using the cash flow for project L or project S in order to compute IRR on your calculator or Excel, you're going to use the difference between the cash flow for project L and S, and then compute what will be the IRR in this case. This IRR will actually be the crossover rate. It will be the rate at which the NPV of project L is equal to the NPV of project S. So let's maybe try to compute that using a calculator. So what do you do? First, you clear your calculator, clear your cash flow, register. First cash flow for year 0 would be whatever is the difference between the cash flow in year 0, which is here 0. So 0, enter, down arrow. The difference between the cash flow in year 1 is minus 60, so that will be your cash flow for year 1. So you're going to put 60 minus, enter, down arrow. How many times? Once. Then cash in year 2, the difference is 10, so you're going to put 10, enter, down arrow. How many times? Once. And then finally in year 3, the difference is 60, you're going to put 60, enter, down arrow. How many times you have that? 1. So then you go to IRR and you press compute. It will give you 8.7% or 8.67995%, and this will be for you your crossover rate. So if you look at this crossover rate, what will happen is that if you're less than the crossover rate, you're going to have a conflict for this L and S, or if you're higher, you're not going to have a conflict. So let's say that you're using Excel and you're trying to determine what's the crossover rate. So using Excel, you're going to enter the difference of cash flow into your as your cash flow now for year 0, year 1, and year 2 and year 3. If my Excel sheet allow me to do it. Okay, I was trying to put it on this side so that I can see the value, but it doesn't seems to want to work. Okay, now it's working. So then in year 0, the difference was 0. In year 1, it was minus 60, so you put minus 60. In year 2, it was 10. In year 3, it was 60. So then you go to IRR, you put equal IRR. You open the parentheses, you select your array of cells. You close the parentheses and you press enter. So you find the same answer, 8.7%. So then you know that there's a crossover rate. You know that there might be a conflict at one point between these two projects. So the main question would be, why will the NPV profile cross? Why would that be mutually exclusive? But there's most of the time two reasons why projects are mutually exclusive. One reason is the size or scale difference. The size or scale difference is the amount invested in one project is larger than the other one. So let's say that in project S you invest a higher amount at year 0, and in project L you invest a lower amount at year 0, then these two projects are going to cross at one point. In this example, we did not have that, but there are examples where you can actually have a size difference. However, in this example, what we had was a timing difference. So what's the timing difference? It's if most of the cash flow of one project come in early, while most of the cash flow of the other projects come in later. And let's go back to our crossover rate, because I have the cash flow there. So look at the cash flow for project L. In year 1, you do not get much. You get just 10, in year 2, 60, and then in year 3, 80. However, in project S, in year 1, you get most of the money. You get 70, then in year 2, you get 50, and then you get 20. So what happened is that project L give you the cash flow slowly, while project S will give you the cash flow faster. So this will actually lead to a cross, and this will make the profile actually to cross each other. Okay, another element that you need to know is, in this case, if there's a cross or if there's a conflict, which method are you going to use? The method that you're going to use is NPV, and I will explain why. It's all based on the reinvestment rate assumption. NPV assumes that your cash flow are reinvested at the cost of capital. So if you say your cost of capital is 10%, NPV will assume that you're going to reinvest your money at 10%. IRR doesn't assume that. IRR assumes that you reinvest at IRR, which is not true. When you invest in your project, you're going to invest at the cost of capital, not IRR. IRR just gives you an idea of how much you're going to receive, but that's not actually what you're going to use for your investment. So then, assuming that the cash flow reinvested at the opportunity cost of capital is more realistic, because in taking account what the cost that you're actually using. So for this reason, whenever there's a conflict, NPV is the best method. NPV allows you to take in account the cost of capital that you're actually using for your investment. So if there is a mutually exclusive project, if you have a conflict between projects, go with the answer that NPV gave you. If NPV gave you an answer that one project is better than the other one, that's the project that you're going to invest in based on your cost of capital. So the question will be, okay, if the IRR doesn't take into account cost of capital, then I don't think it would be a good method to use. Then that would be the question. However, there are other ways that we can actually use the IRR to our advantage. What we can use an hybrid form IRR that actually assume that the cost of capital is the amount that you're going to use, or is the cost or the return that you're going to use to reinvest. So that means that we add the modified IRR, or the hybrid version of IRR will not use IRR as the element that you use to reinvest. No, it's going to use the cost of capital as the reinvestment rate. And then let's see what's this modified IRR is. What is this hybrid IRR? So manager preferred sometime IRR to NPV because it allows them to see percentages. So then if you tell to an investor, oh, your percentage return is 10%, they're more likely to understand what you're saying. However, the issue with that is that IRR is not always the best measure. So what they can use if they want to look at the return is actually use a better IRR measure, which is called the modified internal rate of return. The modified internal rate of return is the discount rate that causes the present value of a project terminal value to equal the present value of the cost. So what you're going to do, you're going to determine the terminal value by determining what will be the future value of all the positive cash flows at the end of the project. And then you're going to determine what is the present value of all the costs at the beginning of the project. And then you're going to determine what is this rate for which you're going to get your present value of cost equal to your future value of cash inflow. And this is the formula that you're going to use. So you can use the formula. Using the formula, it will be present value of outflow equal terminal value of inflow divided by 1 plus IRR. And what you're going to do, you're going to use trial and error and find what is this rate That makes your present value of cash flow equal to your terminal value of inflow. Or if you're using your calculator, you're going to first determine what's your present value of outflow. So what's the present value of all your cash outflows? And then you're going to determine what's the future value or the terminal value of all your inflows. And then you're going to enter your present value of cash flow as your present value, your terminal value of inflow as your future value, and then the number of period will be the number of period for the project, and you compute for the interest. If you're using Excel, there's actually a built-in function which is MIRR. So you're going to put equal MIRR, select the array of cash flow starting from cash flow 0 to the last cash flow. Then you're going to enter a finance rate and a reinvestment rate. Note that for Excel, the finance rate and the reinvestment rate are actually the cost of capital. So that means that you're going to have your cash flow and then cost of capital, and determine what will be the MIRR. So let's go over an example on how to calculate the MIRR. So here we're going to look at project L only, and you can try to do the same for project S later. So project L, if you remember, we had different cash flow. Cash flow 0 was minus 100, cash flow year 1 10, year 2 60, year 3 80. So if you're computing the MIR, you need to determine what are your cash outflow and what are your cash inflow. Here minus 100 is your cash outflow, 10, 60 and 80 are your cash inflow because they have positive sign. So what you're going to do first, compute the present value of your cash outflow. We have minus 100. Present value of minus 100 at time 0 will be the same value. Why? Because we're at time 0. So your value would be minus 100,000 or 100,000 as your present value. Then you're going to compute what's the future value for each of the cash flow at year 3 and then do the sum. So let's use the calculator to do that. So if you're using the calculator, which we're going to use here, you're going to actually compute the value for each of the cash flows. So you take first the cash flow in year 1. Cash flow in year 1 is $10. So you're going to put that at your present value for year 1. So remember, the present value is always a negative value, so minus present value. Then how many years do you have from year 1 to year 3? You have 1, 2 years. So then your number of period would be 2. And then you're going to put your cost of capital, which is here 10%. So 10. Is there any payment? No, so 0 payment. And then you compute your future value. Okay, what happened? So to compute the future value for the $10 at year 0, you're going to put 10 or minus 10 at your present value. Then your number of period will be how many period between year 1 and year 3, which is 1, 2 period. So you're going to have 2 as your number of period. Your interest will be your cost of capital, which is here 10. Your payment will be 0, and you compute for your future value. So then if you're looking at your $10 at year 3, you're going to have $12.1. You do the same for year 2. In year 2, your cash flow was 60, so your present value will be minus 60. How many years between year 2 and year 3? 1. So that would be 1. Your interest is your cost of capital, which is 10%, so 10. Your payment is still 0, and you compute for future value. That would give you 66. So finally, you have year 3. You have a positive value there also. So present future value of $80 at year 3 is $80 because that's when you're going to get that. So then you're going to do the sum of all the future value. So here for 80, you have a future value of 80. For the $60, you have a future value of 66. For the $10, you have a future value of 12.1. So that gives you 158, which is your terminal value for your inflows. So now what are you going to do next? So now what you're going to do next, you're going to determine what's your MIR. Using the formula, you're going to set up your present value of cash flow as a positive value, so 100, and then your terminal value of inflow will be in the denominator, and then you're going to have 1 plus your modifier r as to the power of the number of period, which is 3, as your numerator. Then trial and error. It will take a long time if you're trying to do that. If you're trying to do the trial and error, it will actually take you a long time because you have to put interest inside until you get actually the value that you need. Or you use your financial calculator. So in your financial calculator, you're going to enter the present value of outflow as your present value, the terminal value of inflow as your terminal value, the number of periods will be the whole project, which would be 3 years, and then you compute IRR. So let's use my calculator here. So first, let me make sure that I clear my TVM. So then, number of periods will be 3 because project L is for 3 years. What will be the cost of capital, the interest here? You're not going to put anything because that's what you're supposed to compute. So what you're going to go towards is the present value. What's your present value? The present value of cash outflow. So that will be minus 100 as your present value. Then, is there a payment? No, so payment will be 0. And your future value will be the terminal value of your inflow, which is 158.1 as your future value. So then you go back to your interest, you press compute, press your interest, that will give you 16.49 or 16.5%. So the question would be, what if I'm using Excel and I don't use a calculator and I don't have a calculator? That's fine also. So what you need to do for Excel, let's go back to our Excel sheet, is to make sure that you use the MIRR function. So let's try to use that here. So you're going to go equal MIRR, and you open the parentheses. It's going to ask you for the value, and then it's going to ask you for the finance rate and the reinvestment rate. So since we're looking at project L, let's input the values that we had for project L. In times 0, we had minus 100. Times 1, it was 10. Times 2 was 60. Times 3 was 80, if I remember right. Yes. The cost of capital is still 10%. So now, let's set up a MIRR. So you're going to have equal MIRR, open the parentheses, select the area of cells. Remember, for the IRR and MIRR in Excel, you have to select the area of cell. You cannot select each cell. So you have to select all of the cells together. Then it's asking you for the finance rate. Remember, MIRR, the finance rate will be the cost of capital. Rate of reinvestment will also be the cost of capital. So the assumption is your rate of reinvestment, your finance rate are both the same. So then you close the parentheses and you press enter. And it will give you the value, which, let's get some decimal, would be 10.5%, which is the same thing that we found before. So these are the steps that you have to follow when you're trying to compute MIRR. First, you need to determine what's your present value of outflows, then determine what's the terminal value of inflows, and then use that using your financial calculator or using Excel to actually compute what's the interest rate for which the present value of outflow will be equal to the future value of the terminal value, or the terminal value of inflows. And what's the assumption here? The assumption is that you accept the project if MIRR is higher than the cost of capital. So here we found that for project L, the MIRR was 16.50%, cost of capital is 10%, so you're going to accept this project. So the question would be, why would you want to use MIRR versus IRR? The great answer is that MIRR assumes the reinvestments are made at the opportunity cost, which is the cost of capital. It assumes that the cost of capital that you determine that you're going to use for your investment is actually the cost of capital capital that you're going to use also for the reinvestment, which is the same assumption than NPV, and which is very helpful. The second element why MIRR is good is that it avoids the problem of multiple IRR. There are sometimes projects where instead of having only one IRR to make your decision, you can have 2, 3, 4, 5, 6, 7 IRR. So then which IRR are you going to take? The MIRR allows you to actually determine an IRR that can be used for the project, and that will only be one IRR, which will be the modified IRR. Another reason why MIRR is good, most managers like rate of return comparison. So when they give the information to the shareholder, they like to say your return will increase by 5%, 20%, or 10%, or 5%. The MIRR allowed them to have that, to be able to say by how much or by which percentage the value of the firm will increase, and it controls for the reinvestment rate, and also control for other issues that can happen. So in the previous discussion, we discussed that MIRR allow you to avoid multiple IRR problems. However, so far did not show you instances where you can actually have multiple IRR problems. For you to understand these instances, you will have to discuss first about the difference between a normal and a non-normal cash flow stream. A normal cash flow stream will have a cost at your zero, negative cash flow at your zero, an investment at your zero, and then every other year you're going to have a positive cash inflow. So that means that you're going to have the profit every year, so you're not going to have any losses. There is only one change of signs. You go from cost in your zero to positive, 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 positive until the end of the project. However, in real life, it's not always that easy. It's not because you pay the cost today that you're going to have a profit every year for the next 5 years or 10 years. There are instances where you have a cost, you have a profit, then you have a loss, then you have a profit, then you have a loss again, and then you have a profit. That's a non-normal cash flow stream. In non-normal cash flow stream, the cash flow stream where you have 2 or more changing signs. So most common, what you have, your cost, negative cash flow at your zero. Then you're going to have a string of positive cash flow like every year, and then the last year, when you want to close the project, you actually have a loss because you're trying to actually close the project and you're actually trying to sell everything back and everything. You get the loss at the end. That happens actually when you have like nuclear power plants, when you have strip mines, stuff like that happens. So in this case, what will happen is that IRR will not be a good measure for you. Why? As the number of change in signs will increase, the number of IRR will increase also. If there's more change in size, that means there's more chances that at one point your project value will be equal to 0 or your NPV will be equal to 0. There's more chances that you have multiple points where your project is actually equal, your NPV is actually equal to 0. So in this case, you can also use the modified IRR to control for that. So this is an example, and this time we're not looking at project S or L, we're looking at project P. And we're trying to determine the NPV and IRR for project P. So project P has the following cash flow. In year 0, you pay the cost, 800. Then in year 1, you made a profit, 5,000. And in year 2, you made a cost again. You had a cost again, minus 5,000. So the question is, what will be the NPV for this project? So you can use your calculator or you can use Excel. So here the example shows you how to do it with your calculator. So let's use the calculator. So remember, each time you go to your calculator, make sure that your cash flow register is empty. Okay. So what's the cash flow for year 0? It's minus 800. And then you press minus, enter. Then in year 1, 5,000, and it's positive. Enter. How many times? Once. Then in year 2, minus 5,000. Enter. How many times? Once. So then you go to NPV. Your cost of capital or WACC here is 10%. So you put 10. Enter. Go down arrow, and NPV shows, and you say compute. And you can find the NPV, which is 300 minus 386.78. I know looking at NPV, you know already that you're not going to accept the project. But what we're going to do here is not to worry about that, because we're trying to understand how the modified IRR actually helps here. So don't worry, I know the project is not a project that you're going to accept, but let's entertain me a little bit more. So what happens if we're trying to compute IRR? And I'm going to show you that on the calculator, and then I'm going to show you that on Excel, and you'll see something. So on the calculator, you already have the cash flow inside, so you go IRR, you compute, give you 25%. 25% is higher than 10%. Looking at IRR, you might want to invest, but remember, NPV is the best methodology, or is the best method to use. Let's use the Excel spreadsheet now. Okay. Okay, so let's put the value that we have in the Excel spreadsheet. So in year 0, we have minus 800. In year 1, 5,000. In year 2, minus 5,000. So here you see it gives you all the values as I kept the formula. So NPV, we did NPV, we did the interest, which is 10%, and then you include CF4 or CF1, which is before CF2. Here we do not have a CF3, so we're not going to include that, and you add the CF0, and that gives you the same answer. You do that with IRR, you select all of the array, which is here B3 to B5, and you find the same value, and it already gave you the MIR, but I want you to do like you didn't say it. So we found the same IRR in the calculator. Do you think that you can invest in your project now? With the NPV, you know that you're not going to invest in the project, but just look at something. So let's say that we put again the formula for IRR. Open the parentheses, select the values, and then we get, let's say, a IRR of 250%. And we close. Press enter. What happened? What's the value of IRR now? 400%. What's the value of IRR we had before? 25%. Do you have one IRR? No. Do you have two IRR? Yes. And for the people using the calculator, they may wonder, how do I know if I have two IRR if I don't use Excel? With your calculator, you might not know, because your calculator will not show you the two IRR. However, it will only show you the first one. But however, a very good indication of how many IRRs you have is to look at your cash flow. Here, for example, at time 0, you have a negative sign. Then at times 1, you have a positive sign. That's one change in sign. Then at time 1, you have a positive sign, and then at times 2, you go to negative. That's two change in sign. So if there's two change in signs, there's two IRR. If there's one change in signs, there's one IRR. If there's three change in signs, there's three IRR. So if you're using your calculator, you want to know right away if there's more than one IRR, just look at the cash flow. If you see more than one change in signs, that means there is more than one IRR. So the question will be, what do you do if you have multiple IRR? So as we saw with Excel, you see you have two IRR. You have a IRR that's 25% and a IRR that's 40%. So the question would be, which one are you going to? Capital is lower than 25%, you're going to accept. But what happens if your cost of capital is higher than 25% but lower than 400%? Are you going to accept? Are you going to reject? Make it difficult for you to even make a decision. So then you're going to use the modified internal rate of return again in order to solve this issue. So let's apply MIR to our project B. So the question that they're asking you is that, when do you use MIR instead of IRR? You will use MIR instead of IRR if you have non-normal cash flows. That means if you have more than one chain inside. If you have more than one chain inside, what happens is that you're going to have more than one IRR, and as I told you, one chain in size is one IRR, two chain in size, two IRR, three chain in size, three IRR, five chain inside is five IRR. So then in project B, we actually have two chain inside, so we had two IRR. So then we can actually use MIR in order to compute what would be the value of or what would be the rate of return or internal rate of return for project B. So like we did for project L, you're going to determine your outflow and your inflow. So if you remember looking at project B, you have the outflow of minus 800 in year 0 and minus 5,000 in year 2. And you have the cash inflow of 5,000 in year 1. So what you're going to do, determine what's the present value of outflow at the cost of capital of 10% for the outflow of minus 800 and the outflow of minus 5,000, and then determine what's the terminal value of inflow or the future value of the positive value, which is the 5,000. So then let's try to use a calculator. So first we compute the present value of the minus 800 at year 0. You get the minus 800 at year 0, so the present value will still be minus 800. So your present value of outflow will be minus 800. Then you have minus 5,000 at year 2. So you're going to determine what's the present value of the minus 5,000 at year 2. So then you go back to your calculator. You're going to put your future value as 5,000 or minus 5,000. And you're going to put your future value as 5,000. And you do not have any payment, so that will be 0. You're going to put your interest at 10%, which is 10. And you're going to put the number of periods, which is from year 2 to year 0, which is 2 periods. And you compute your present value. So that will give you for the minus 5,000, that will give you minus 4,132.23. So what you're going to do, you're going to include that, add that to your present value, so that will be minus 800 minus 4,132.23. If you do the sum, you find the same answer, which is 4,932.23. So for this project, your present value outflow will be 4,932.23. Then you're going to look at the inflows and try to determine what would be the terminal value. So to determine that, you're going to set your 5,000 that you get at year 1 as minus 5,000 for your present value. And then there is no payment. The number of year will be the number of year between year 1 and year 2, and year 1 and year 2 it's only 1 year. And the interest will be the cost of capital 10%. And you compute the future value, and that would give you 5,500. So then if you're using your calculator, this is what you're going to do. So first, let's clear your TVM. You're going to include the minus 4,932.2314 as your present value. You're going to include the terminal value, which is 5,500, as your future value. The normal period will be the overall period for the project, which is 2 years. And your payment will be 0, and you compute for the interest, which would be for you your MIRR. So here you'll find that your MIRR would be 5.59 or 5.6%, which is what you have on the slide. So let's say that you are using Excel, then you'll only have one step to go. So if you're using Excel, and let me clear all these writings first. Okay. So if you're using Excel, the only thing that you have to do is to put equal MIRR, open the parentheses, select all your values, or all the cells with the values, and select your finance rate, which is 10% for the cost of capital, and your reinvestment rate, which is 10% also for the cost of capital, and you press enter, and that will give you 5.6%. So if you're using MIRR, you just need to select your cash flows and select your cost of capital twice, and you find the same answer, which is 5.6%. So then if you look at the MIRR and you compare it to the cost of capital, then you find the same answer than your NPV. You're not going to invest in this project because the MIRR is lower than the cost of capital. So this is it for the chapter 11 on basics of capital budgeting. We're not going to go over payback period, but I wanted you to actually know what is the NPV, IRR, MIRR, and how you can use that to determine between projects. Most firms will use either one of the three methods in order to choose between projects. So I wanted you to be familiar with this method, and this method make sure that you remember that the most efficient will be the NPV, because the NPV has the reinvestment rate assumption, and MIR helps with that. But if there's a conflict, always go with NPV. Thank you.